No matter what these billionaire investors and traders say, it's actually very easy to beat the stock market. Hear me out. All you need to do is invest the same amount in a low-cost S&P 500 index fund every month or week, whichever suits your schedule, and then, whenever there's a recession or a dip in the market, you buy more than usual. It's called dollar-cost averaging with a twist. Keep some cash on hand or in liquid investments that you can quickly sell when those discounts hit. Now, before you grab your pitchforks and tell me it's not that simple, yes, there are some assumptions here. First, we're banking on the fact that the stock market will continue to rise over time as it has historically. The moment you start investing could be just before a market crash that never recovers. But hey, that's the kind of luck I have when I invest in random cryptocurrencies, so welcome to my world. Still, the key idea here is taking advantage of those dips. If you stick to this plan, buying more during downturns, you'll likely beat the market in the long run, at least by a small margin. Now, I'm not telling you to go full Wolf of Wall Street studying charts for 12 hours a day, but you can use simple indicators to help guide your extra purchases during downturns. For instance, you could follow a moving average like 90 days. If the stock price is below that average, then bingo, it's time to buy more. This strategy doesn't require genius-level math. It's not foolproof either, but it's a handy guide for knowing when to take advantage of temporary market freakouts. Because let's be honest, the market freaks out more than my cat does when I turn on the vacuum cleaner. If you can jump in during these moments of panic, you'll come out ahead once the market inevitably bounces back. Unless it doesn't, of course. The US stock market has been on a mostly upward trajectory for over a century, but there are times when it takes a breather and declines for several years in a row. If you invested at the peak of the year 2000, it took about 15 years for the S&P 500 to reach those highs again when adjusted for inflation. That sounds pretty rough, right? Well, only if you threw all your money in at that peak and called it a day. But if you kept investing month by month over those 15 years, your returns would have skyrocketed afterward. That's the magic of dollar cost averaging. You're not worried about catching the exact top or bottom because you're always in the game. And trust me, the hardest part of investing is staying in the game. Warren Buffett himself, probably the most successful investor in the world, said it best. A low-cost index fund is the most sensible equity investment for the great majority of investors. And this guy started investing at age 11, so he knows a thing or two. Some people think they can do better than the S&P 500 by picking individual stocks. Maybe you're thinking, I'll just pick the next Amazon or Tesla. Well, spoiler alert, it's not that easy. Even hedge funds, which hire whole armies of analysts and probably commit insider trading to hunt down the next big thing, have a hard time beating the market. A lot of them actually don't. So unless you really enjoy the adrenaline rush of stock picking, the smart move is to stick with index funds. But let's not limit ourselves to the S&P 500. There are tons of other index funds tracking different markets around the globe. For instance, India's Nifty 500 has outpaced the American equivalent over the last 5 years. Who knew? If you really want to juice up your portfolio, emerging markets are where it gets interesting. These markets are kind of like undiscovered bands. Once they gain traction, those who got in early see massive returns. Take Mark Mobius, for example. This guy became a legend for betting on emerging markets in the 80s, long before it was trendy. He started with a $100 million fund at Franklin Templeton and turned it into over $40 billion in a few decades. And let's be clear, you don't need $100 million to start. Just like how people have made fortunes steadily investing their salaries in the S&P 500, emerging markets offer the same kind of long-term opportunity. Don't just put all your eggs in one basket, even if that basket has been as reliable as the S&P 500. Diversifying across global markets can help protect your portfolio from regional downturns or political instability. Think of it as an insurance policy for your investments. While the US market has been solid for a century, that doesn't mean other countries won't have their moments. India, as I mentioned, is one hot market right now, but who's to say Brazil or Southeast Asia won't be the next big thing? Probably the hardest part of this strategy is keeping your emotions in check. When the market dips, your first instinct is probably going to be panic selling. But in reality, that's when you should be buying. It feels counterintuitive because when the sky's falling, it doesn't feel like a shopping spree moment, but that's exactly when you need to stay calm and buy. And look, if you can't do this, it's okay. You're human, most likely. This is where automating your investments helps a lot. Most broker apps or banks will let you set up automatic deposits into your index fund of choice. You don't even have to think about it. It's like signing up for a Netflix subscription, except instead of mindlessly streaming brain rot shows, you're growing your wealth. At the end of the day, beating the stock market isn't about finding some magical stock or being a financial wizard. Of course, you can buy individual stocks too at the same time, but it's about consistently investing, taking advantage of market dips, and playing the long game. As long as you're disciplined and patient, you can outperform the market by that small but significant margin. So don't stress about stock picking or timing the market perfectly. Just keep investing regularly, and when the market decides to freak out, because it will, buy even more. And one day, while the billionaire hedge fund managers are licking their wounds, you'll quietly be sitting on some nice gains. Have you already started investing in index funds? Let me know in the comments below. Thanks for watching. Like the video and subscribe to my channel before you go.